better late than never. Anyway, we won't get into the fact that about technology. But look, before I start, I'll just say, first of all, on behalf of those present, I would like to acknowledge the Gadigal of the Eora Nation as the traditional custodians of this land I'm presenting on, and pay my respects to the elders of both past and present. So for those of you I haven't met, I'm Amanda Price. I'm the head of High Growth Ventures. We're a team within KPMG that is 100% dedicated to working with startups. We've developed a range of products that are specifically priced and designed to support founders from Series A and beyond. Thanks to everyone who submitted questions today. We've used the questions to form the basis of the discussion. But if there is any more, then please just feel free to text me in the chat, because I'll just keep reading those out as we go, because it is a Q&A, so we are wanting questions from the audience, so feel free. So today's topic is, I've got to say slowly because it's hard. Slowdown means reevaluating valuations. How to avoid a down round for your startup. So I'm joined by three people today who are extremely well qualified to explore this topic. Firstly, Benjamin Chong, partner from Right Click Capital. Georgia King-Siem, a partner at KPMG in our Accelerating Business Growth team. And Joel Thornton, not a partner, but from Fundsquire, but a head of national partnerships and sales lead. Welcome all, and thank you for joining us today. So I'm aware, like in the way we've sort of structured the questions, we've got sort of three buckets in terms of valuations, which is Benjamin. We've got some sort of alternative funding through Joel, and then we've got R&D and government grants with Georgia. But so feel free, guys, panelists, I want you to jump in. Feel free to comment on areas that aren't your area of expertise. Be controversial. Let's get it going. To start, I'd like you all to introduce yourselves individually and let the audience know why you are qualified to talk about this topic, and also maybe a comment on what you're seeing in today's market. I'll start with you, Georgia.
Oh, thanks, Amanda.
And go.
Okay, well, as Amanda said, I'm a partner in the Accelerating Business Growth team, and that is exactly what we do, is helping businesses accelerate their growth through government support predominantly. So that's going to be whether it's R&D tax incentives or more broadly tax incentives, even investor tax incentives, or grant funding of various forms. I've been doing this for about 10 years, and my background is also around policy. So I'm also KPMG's innovation policy lead, and I sit on the budget team each year, looking at what government is doing, both at a state and federal level, to help business, particularly around startups and growth and innovation. That's me.
Excellent. Benjamin.
Apart from being an admirer of Amanda, on this call,
which is no doubt a full-time role,
such as Robin, great to see you. I've been fortunate to have been through that process of having started, built, bought, sold technology companies since the 1990s. And these days I'm a partner at Right Click Capital, where we invest in bold and visionary tech founders in Australia, New Zealand and Southeast Asia. So really glad to be here.
And Joel.
Yeah, thanks, Amanda. So I guess I'm going to be providing a bit of context from the non-dilutive perspective. So pretty common strategy for a lot of businesses to avoid a down round or to buy themselves some more time is to seek out those alternatives that Fundsquire typically provides. So we're in the business of providing founders with the option of getting access to safe and scalable and transparent debt solutions. Working with businesses all the way from like pre-seed stage all the way through to like Series C businesses that are scaling rapidly. I guess touching on what you said before, what I'm seeing is like there is a big push for founders to seek out those alternatives. So I've probably got a bit of a confirmation bias due to the fact that I'm speaking with founders and CFOs every day, and but I'm hearing a lot around like capital raises taking a lot longer to complete in the current market. And I guess that's why we've seen a big increase in the number of businesses that we're speaking to.
Excellent. All right. Benjamin, I might start with you. Seeing you're my biggest fan, you can go first. Okay, so a lot of the questions we get are, what's the difference between an up and down round?
Right.
Let's start with that.
So ordinarily, let's say you go and raise capital for the very first time. An investor gives you a pre-money valuation of $4 million. They put $1 million into your company. You'll have a post-money valuation of $5 million. 4 plus 1 equals 5. And then you've made progress with your business and you then want to go and raise more money. And let's say your new investor decides to give you a pre-money valuation of $10 million. That is an up round because the pre-money valuation is greater than your most recent post-money valuation. If your business has got the same post-money valuation of $5 million and you take on, say, another $1 or $2 million, that's what you'd call a flat round. And then if the new investor says, look, I know you had a post-money valuation of $5 million. We're wanting to give you a post-money valuation of $4 million and give you, say, $2 million. Well, that would be a down round, in which case that down round is down by 20%, as opposed to it being up by 100% going up to 10 million.
Right. Okay. And so what's the difference? Like when we spoke the other day, you were talking about the different types of down rounds, like voluntary and involuntary. Can you go into that a little bit as well?
Yes, that's right. It's like a voluntary administration.
Yeah.
That's another team at KPMG that we can organise with that, and hopefully you don't need that.
Nope.
Not right now. But a voluntary round, and it's more of a tongue-in-cheek. Sometimes a down round occurs because you have an investor in your company who decides to sell shares at a price that is lower than your most recent post-money round. So if they sell, so what do I mean by this? Let's say you've got this scenario where your shares, you've got 5 million shares now on issue. You had 4 million on issue before. A new investor has subscribed for 1 million shares at $1 per share. So there's 5 million shares on issue, each at $1 per share that value. And then one of your investors decides to sell 100,000 shares, but at 50 cents a share. Then that's $50,000. That would imply, if you think about it, a value of $2.5 million. So that sometimes happens, right? Because
can they do that? Can they just go and do that? Like,
well, it's something.
I mean, why would they is one
Right.
thing, but if they wanted, if they needed the cash or whatever, could they just do that? And
Well, yeah. If I own shares in a company, I'm allowed to sell them, subject to the shareholders' agreement. Usually, there would be preemptive rights where I need to sell to existing shareholders or offer my shares to the existing shareholders first. But if those existing shareholders don't want to buy my shares because they don't want to give me the money, then I'm allowed to sell them to other people, and I could sell them for a low amount. So that's involuntary. That happens from time to time. Sometimes you can imagine a situation where you've got an investor who has a forced sale. Maybe they need to sort out a relationship matter, or maybe they run out of cash and they really need to sell the shares fast. That's one of the circumstances where a discount might take place. And imagine that in a backdrop where perhaps the company's performance has not been so good. Double whammy. So discount.
Ben, I've got a question there very quickly, if I may. So
you may.
I'm guessing if somebody is going to sell out, presumably they would sell all their shares, because if they're selling only part of them, then they're devaluing their other shares.
Yeah,
that's right. So usually
it's really all or nothing.
Yeah, it's usually all or nothing, and unfortunately these things happen, right? Because and we don't foresee these circumstances. Maybe there's a relationship breakdown and you need to settle the financial arrangements there. So that's on the involuntary side. Thankfully, most of the rounds that people get involved with are voluntary, and that is where you are raising capital for the business. Where when you're raising money, you're issuing new shares, and because the company is issuing the shares, the money goes into the company's bank account, whereas the involuntary is usually where you are trying to, someone with existing shares is selling their shares. So it's what we call a secondary sale, because the company is not really issuing new shares in that instance.
Yeah, and without getting into specifics, I'm assuming you may have some companies in your portfolio that might have to do a down round, and if so, like how do you counsel them through that? Like how do you work with them around that? Because it seems that a lot of the founders we're working with, they certainly don't want to do a down round, and there's obviously financial reasons for that in their minds, but also there seems to be, I wouldn't say shame, that's not the right word, but there's certainly they certainly don't want to tell anyone about it. It seems like a thing they don't want to talk about. What do you find? How do you speak to your founders?
Look, I can understand why there's a bit of shame, because if you go into the example that we had before, let's say we raised the money at 5 million and we are hoping that $1 million worth of new capital could allow us to grow the business so that we could then post a new valuation of circa $10 million. And let's say things don't go to plan, but we still think that there's an opportunity here to grow the business. We want to raise capital, but the investors that we're approaching don't think our business is worth that much. Well, I would suggest, generally speaking, it's still better to get access to capital so that you have another shot on goal, you have another shot at glory. Of course, capital can take many forms, and we'll get to that later. But let's say it is of the equity nature. I would say there are a couple of ways that you can avoid a down round, and we can talk about how structure can come into the picture to avoid a down round, at least on paper. I'd also let you in on another secret. And that is, down rounds do occur, but if I'm an investor and am suggesting that there ought to be a down round, we want to make sure that the people who are going to be critical to the success of the business still have a sufficient level of motivation to be able to take that business back to glory. So there have been times, for instance, where, yes, there has been a down round and the investors who have come before have had to take a haircut. Sometimes it's a crew cut. And then, not good, especially when you've got real hair like me. And when that crew cut takes place, there can be a reissuing of ESOP to key people, or the issuing of what we might call performance or flowering shares to the founders or the key management upon achievement of goals. Because we want the pie to be as big as possible, and we want for the founders to be rewarded if they're going to be responsible for growing that pie.
Yeah, yeah. A sort of a side question, but over the last 12 to 18 months, we've seen companies raise one up round after another up round after another up round, but on the face of it, their performance doesn't seem to have matched those up rounds. Can you just comment or just talk a bit about that, and whether we're going to continue to see that going forward?
I suspect that the period, the time frame from when people raise one round compared with their next round will go back to a more normal pace. I suspect it will go back to a more normal 18, 24 months, maybe even a bit, 30 months pace, as opposed to, wow, we raised money in month 0 and now in month 8 we've raised some more. I think a lot of that was driven by some funds having FOMO, and a bunch of those companies, if they did raise money and that money has remained on the company's balance sheet, they'll still be okay. They'll have a ton of cash on hand. I suspect the situations where it's going to be more difficult will be where companies have gone and spent that money, perhaps not on the most on the most judicious projects or expansion plans, and that's why we're seeing a realignment of resources.
Right.
Very diplomatic.
Yeah. Very. Joel, we might just throw over to you in terms of sort of some of the funding that you're supplying. So do you want to sort of talk through this alternative short-term debt funding? What is it, and when should founders consider it?
Yeah, sure. So I guess from our perspective, it comes in a few different forms, and it probably depends on the stage of the business and where they're at. I'd say it's probably never too early to explore your options, have conversations and find out information so you can make the right call when it's appropriate for your business. So on the earlier stage, it probably looks like from us a check size of like 40 grand, where it might be like a couple of co-founders that are still trying to build that first iteration of their product, of MVP. But practicality probably comes down to the specific circumstances of the business. So the real value that Fundsquire brings, particularly in the current market, is helping startups to have a diverse funding mix. So what I mean by that is maybe not don't have to raise as much or as often. So Ben was talking about that before, where we might see equity transactions take a more normal time frame, or like a more normal stance where you won't see businesses raise and then a few months later raise again. It'll go into a more natural flow where you do like your Series A, and then like 12 months later or 24 months later you'll do your Series B, etc. So I'd say the real most common examples that I come across in our client base is businesses that have just raised their Series A and now they've got a real mandate to invest heavily and scale rapidly. And in that situation, we're used in two reasons really, and that's to extend the runway. So you've got this money in the bank, you've got a plan, you know how long that's going to last you, and then you can top that up with debt to extend that runway even further. And to buy yourself more time to get to the milestones required to unlock that Series B transaction. And then also to double down on firepower to really grow rapidly as well. So like the revenue-based funding that we do is really tailored towards businesses that are looking to invest in sales and marketing. So having that extra capital to do that without having to sacrifice on runway or depleting your runway in a rapid way, then that helps you to grow rapidly and look more appealing for those future transactions as well.
Yeah, and can you explain like revenue-based financing that's sort of new here? Do you want to just sort of explain how that works, who that is best for and who it doesn't work for?
Yeah, so I'd say it works better for businesses at different stages in the startup life cycle. So if you think of like a big enterprise SaaS startup, probably has to reach a certain point of scale before revenue-based funding becomes appropriate. Why is that? Because they need to think, when you think of, it needs to be consistent revenue. So coming in for the repayment mechanism to work on like a monthly basis or a consistent basis as well. So when you think of an early stage SaaS product, the revenue profile might be a little bit inconsistent because long sales cycles, sporadic renewals, all those kind of things. It's a bit hard to model out from our perspective what the funding is going to look like. So I'd say that the profile tends to work really well with B2B SME SaaS products, purely just because it's the opposite of what I just said, right? So they scale much earlier, shorter sales cycles, churn becomes less of a risk as well, because they might be 300 grand of MRR across 100 clients instead of 3 million of ARR across 5 clients, right? So churn doesn't become as much of an issue in that situation. So again, I would say everyone should probably consider this as an option, but it's probably a good idea to understand what it looks like for your business and when the appropriate time is to take it seriously. So from our perspective, we want to see consistent revenues. Doesn't need to be growing rapidly, but we need to see a healthy gross margin as well because of the way the repayment mechanism works. Yeah. And then there's probably needs to be a little bit of a runway in there as well. So I'd say like a 4-month runway is probably where you want to be looking if you want to explore revenue-based funding as well.
And do you take equity as well, or is it just basically the loan, paying off the loan?
No equity at all on the Fundsquire side. So like a lot of what we do and what I talk about is like helping founders to understand the benefit of using debt and how that can be beneficial from a dilution perspective.
Yeah. And Benjamin, from your perspective, like, you know, seeing startups now look at these sort of, not alternative, but sort of different sources of funding. And if we include, say, like crowdfunding, and so you've got debt, crowdfunding, revenue-based, I'm sure there's more revenue-based funding. When you look at that from your perspective, how does that work? Like, is there any sort of repercussions that might have later on when they're going to go and do a Series B, C? They've got all these different funding elements in the mix.
I would say that a good business person is going to make use of a range of sources of capital, and some of it's equity, some of it's debt, some of it's debt-like. And if you can get access to government grants, which I'm sure Georgia's going to tell us all about, and you can even get the financing for those grants, like the R&D tax incentives, so that you are going to get the funds now, even though the government will pay the grant in 6 or 12 months' time. That's a wonderful thing because it allows for you to get access to cash and increase your working capital. And we know that access to funds is the lifeblood of business.
Yeah, and just on that, so you just touched on something. So Joel, can you forward, like if I know I've got to put an R&D claim in, will you let me borrow in advance of that on the promise of that grant? And what happens if I don't get the government? What happens if I don't get the government grant, or what happens with that?
That's why we work with the best in the business, like Georgia. So we have processes in place where that it becomes a lot less of a risk, because the businesses are typically working with R&D advisors that we know, and that we trust, and we know the quality of their work. So you're right, we allow businesses to bring forward the R&D credit into the financial year. And I guess one of the benefits that people maybe don't connect the dots with usually around that is, if you have access to that now, you can spend it on more R&D. So
yeah,
the government doesn't care where you get the money from, as long as you're spending it on R&D and you're creating jobs. So right, so if you can bring it forward, you can spend it on more R&D, and you're compounding your credit. So it's it's got a really good use case for allowing businesses to increase their speed to market, because they're getting access to more capital and they're compounding their credit, which means that they're going to get a better refund at the end of the year. And businesses have better use for that money now than in, as Ben said, 6 to 12 months, or however long it takes to get out of the government.
Yeah, right. Georgia, are you seeing that at the moment? Are you seeing companies pull that forward?
Yeah, I mean, look, traditionally they will anyway, and absolutely agree with Joel. Like, it's a very valuable way to get the cash in the door and then spend that, double down on the theme ingredient, and get a greater benefit out of it. I might be a little bit controversial here, though, where I might say what we are seeing with government, and I'm happy to talk about R&D and grant funding, a bit more in a bit later. But if you take a look, what we're seeing from some government is they're changing their funding model a little bit. So instead of it being the traditional grant where it's matched funding, we're starting to see them offering sort of loans and taking equity. And that's something traditionally both state and federal government have really stayed away from, but we are starting to see that. So for the federal government, with the announcement of the National Reconstruction Fund, they've said that will be a mix of, grant, equity and loan. And Breakthrough Victoria has just announced that all of its funding will be equity. So I think that's a really interesting dynamic to throw into this, because it's not a space that government traditionally plays in, or at least if it does, it comes and goes over probably a 10-year cycle.
Actually, that's super interesting. So, Benjamin, what do you think of the government taking equity in startups? What's the pro, or anyone actually, what are, I haven't really heard that before, so I haven't had a chance to think of the pros and cons of that, to be honest.
I have no problems with government taking equity, so long as they approach it as a commercial, as in the management of that equity from a commercial perspective. And I think regardless of where you take your funding from and the form of funding, for any business person, any founder, it's critical to understand what is the motivation of that investor, whether it's a debt investor or equity investor or some other type of investor. Because if you're, say, getting debt, does that need to be repaid within 6 months or 12 months, or is it a revolving facility of 3 years, for instance? And similarly, if it's equity, is the venture capitalist like us, or perhaps an angel, are they planning to come in for a 5-year horizon, an 8-year horizon, or a 25-year horizon? That's rare, by the way. So understanding that's really important. And we would do this if a friend asked you to come out to the party on Saturday, maybe tonight, right? There's a holiday tomorrow.
I love your analogies, Ben.
Yeah, that's right. Well, I'd like to know, where is the party? How long's the party for? What should I wear? Do I need to make plans or not make plans for the next day? So I think it's similar when talking to investors. It's like, what are the expectations? And I think with the government, if they're planning on investing on a longer term basis, a little bit like an angel or a venture capitalist, fantastic. But if they're thinking that they can put equity in and take it out in 2 years, that's when we might have some of those involuntary types of situations.
It is really interesting because, when you do a transaction with a VC, at least you know what the expectations are, right? I'd be very interested to know what the government's like investment horizon is. Like at the end of the day, it's sort of a bit of the opposite of what you see with government, like because government's quite conservative, yet investing in early stage businesses isn't the most conservative investment approach, right? So it's like, but from what I have heard with the Breakthrough Victoria Fund, they are doing really good things with servicing real like need, like say areas that don't get as much love from the VC space. So I've heard them investing in early stage like medical device startups that are coming out of universities and things like that. Typically not the ones that get, it might be a bit harder for them to get access to VC funding at an early stage.
Yeah, I think I'd agree with that. I mean, I think all of these sources, particularly the government programs, have a time and place, and it's about understanding what the objective of those are. So to Ben and Joel's point, really understanding that. I mean, for if it's state government, then do they have state priorities that are going to dictate, what might happen down the track? I'm sure that it's all fairly, patient capital as it's termed, but at the same time, it may come with some strings attached.
Exactly, and I've seen some of these guidelines. Thou shalt employ so many people in a regional area. Thou shalt do this. Thou shalt do that. Which I think, like a lot of things, if there is a good business case for why being in a regional centre makes sense, and if there's access to the talent there, that's fantastic. But if we're forced, because we've taken government money, to employ people who might not have the right skills, then we don't want to hamstring the businesses that we're involved in.
Yeah. Okay. Interesting. Just one last one for you, Joel. Just on debt. The debt, sort of venture debt, has been around, like in Australia, for I think Partners for Growth were, I don't know, Benjamin, if they were the first ones, but they seem to be first in market a while back. And it's funny because in San Francisco, Silicon Valley Bank and everything, they traditionally do a lot of venture debt, and it seems here it still hasn't sort of really taken off in the way that was expected to. And I'm just wondering, from your perspective, what's the hesitancy with venture debt?
Yeah, I wish I had the answer for you. I to be honest with you, I'm not 100% sure, but I am seeing it become more of a thing in Australia. Like you are seeing more people pop up in that space. Like at the moment, like there's Partners for Growth, there's Leap, there's One Ventures, there's Marshall. Those are like probably the big ones that I'm seeing, but I'm seeing it become a lot more of an option for founders as well. Even to the point where I've heard of some VC funds are exploring having their own venture debt fund as well attached to the business, so that they can do that for their businesses as well. If you think of revenue-based funding, I guess that's like a sort of like a junior venture debt product, really. Like has similar mechanisms in that it's got like repayment from revenue. You need to reach a certain point in scale before it becomes appropriate. It's just not going to be the big multi-million-dollar transactions that you usually see from venture debt, and over a longer period of time as well. So I'd say that it's probably a good way for businesses to get a taste of what venture debt might look like without having to dive in headfirst into that space as well.
Yeah. Okay. Yeah, it's interesting. I think there's also a perception. I think what we hear is the perception that I'll lose my house, or that's the general pushback. I think they just go, debt means house. That should be
the defining factor around venture debt and revenue-based lending, is that the guarantor of such facilities is the company and not the founder. So you shouldn't lose your house, you shouldn't lose your car, you shouldn't lose any of your personal assets, your share portfolio, because you're not signing on as a personal guarantor.
Right.
Yeah. Personal guarantees never form part of any Fundsquire arrangements. So like that's completely off the table. We are very much focused on the quality of the business and what the business is trying to achieve. And we don't want to put people in a situation where they're thinking like that, to be honest, where there's the risk of that may be happening.
Yeah.
And the lawyer
I mean,
in me
it's
is just going to put up my hand and say, unless, of course, they're in breach of their fiduciary duties, in which case.
Yes. All of what we say was not accurate.
But no, completely agree. As a general proposition, absolutely.
Right. And yeah, okay, I think that's a good thing for Joel to put out there as well, because we do hear it quite a lot actually. People just assume that's it. So I've always just thought that's probably why founders aren't taking it up. But
just on that,
anyways.
Amanda, I think that like maybe especially in Australia, it seems like there is like this real I don't know, it's almost like debt seems like it's a bad word.
Yeah.
Whereas like, as Benjamin said before, capital in the business, any sort of capital in the business is always a good thing. More capital means you can invest in more growth. So I'd say that I don't know if it's just like a perception from like the big banks where like you need to be profitable for a long period of time before they'll even talk to you about debt. So like a lot of founders write it off at the early stages. But the whole thing with Fundsquire and everything that we do is trying to take debt into spaces where the banks won't touch in a safe way. So it's not like we are in a position, well, to be honest with you, we've had very, very, very low default rates as well. So like we've never not been repaid from the R&D credit or the grant milestone or in the revenue-based funding from the business actually following the plan and repaying us from future revenue. So yeah, that's what I'd say on that side of things.
Georgia. Government grants and R&D. Hey, I think you touched on this before in terms of, we're seeing, well, from our side, a sort of an increase, I think, in government grants at the moment. There seems to be more around. Is that true?
Look, there are and they're not. So, I mean, through COVID, and sorry, I'm just going to move a cat off a table. Thank you. So professional. No, they're really, through COVID, the government pumped an awful lot of money into the economy. There were a lot of grants, there were a lot of sources of cash. To some extent, government has exhausted some of its supply there. And you will often see a cycle where coming into elections, there'll be a lot of announcements, or coming into a budget, such as the federal budget in October. No doubt there will be a lot of announcements around new programs as the new government basically realigns and says, these are our priorities, these are our strategic priorities, and these are what we want to fund and try and get industry to do more of. So those are the strategic priorities, clean tech, agri, med, all the sort of usual ones you would see. In terms of whether that means there's more funding available, I think I would hesitate a little bit, because normally what you see is that they'll rejig it. And as I said, there is this sort of general shift, which I would say is almost like a seismic shift towards using a bit of a mix of debt and equity that traditionally we don't see as much from government. How long that will be the case for, I don't know. And again, everything has a time and place. But what it does mean is if you are looking for government support for the business, number one, not everything is going to be for you. And that's really important to recognise early on, because you can waste a lot of time hunting down lots of grants that you never have a chance of getting, or even looking at the R&D tax incentive. It's a fantastic program and it offers, a really good cash back if you're in that space, but you need to make sure that you qualify for it and you're documenting things in a way that's going to get there. Because the last thing you want to do is, for instance, with R&D tax, get the cash and then go into a round where, you're doing a raise and suddenly there's questions about, well, hang on, how good is this claim? Is there any risk here? So, for instance, I've seen some instances, particularly with acquisitions, where, there's a holdback and a sizable holdback on the founders, just in case there is some, disallowance of the R&D in the 4-year window that can happen in. So it's really important, I think, for any startup or scale up to really almost have, I would call it a bit of a matrix, which is, okay, what sort of government support is there that's available and applicable to me? It's almost like, what's your addressable market? It's not everything in there. It's which of the grant programs am I a good fit for? And then at what time is the most strategic time? Because when you're seeking grant funding, you're applying for it prospectively. They don't give you money for what you've already spent. So that means you go in saying, okay, this is what I'm going to be spending in the future. Whereas R&D tax incentive, well, you're applying for what you've already spent or will spend at the time, and you either qualify or you don't. So they're quite different beasts between tax incentives and grant programs. One is, qualification based, and then the other one is competitive, and it's about knowing what that looks like. So, again, I would just recommend to anybody to map that out and to talk to their investors and people like Joel and his team as well to understand where are my sources of capital going to come from and when is the most strategic time to use government support in whatever form that might be.
And with that matrix, because, it seems from where I sit and, there's new grants that come out at different times. And it also seems that window, it comes out and they come up quite quickly and they close quite quickly. And so is there grants that are just always around? So you can include that in that matrix, and then probably the bottom bit might be these opportunistic grants. Is that the case? And if so, where do I find the list of grants? Like, how do I keep up to date with those grants?
Yeah, okay. Well, look, in a very self-serving manner, I'd say that's what we do as a business. We help our clients understand what's applicable and apply for it. But look, nationally, there's probably about 500 grant programs. There are some ones that are sort of the flagship ones, like the Accelerating Commercialisation Grant.
Yeah.
That's the one that everybody wants to get because it's, it's up to $1 million, and it's the one that everybody thinks that they're going to get. But of course, everybody else thinks that, which means not many people get it, and there's an awful lot of people who waste a lot of time applying for it.
How many people get it, and how many people in that? So I'm looking at it. Is there any way of working out how am I up here in the qualification, or am I down here? Is that, again? I'm not trying to throw to you, but is that what advisors would do? Would help me understand how if I'm going to qualify? And do you have a very good sense of, could you sort of say you are or you're not?
There's two parts. So the first part is the merit criteria for any grant program. And that's really, are you a good fit for it? Because if you don't hit the merit criteria squarely, in other words, you're not the sort of company that the government is looking to put money into, then, you can say the further away you are from those the merit criteria, the less likely you are to even be in the running. So that's the first step. Then the second step is what's the competition like? And that's much harder because you don't know who else is applying. So part of our role, for instance, is number one, knowing what the merit criteria are and being able to tell someone pretty quickly, not a good fit, yes, a good fit, down here it might be, not at the moment, that sort of thing. But then when it comes to the actual application, talking to the program team, they can't, the government team will never tell you what the strength of the other applicants are.
Yeah.
But you do get a good sense of just how competitive it is. And there are some ways we have, I suppose, of understanding just how many are applying and getting a sense of how competitive a particular round is. So that's for your perennial programs. The same principles apply for your one-off programs or programs that sort of open and then a month later they're shut, which is very irritating. But it's the same process. But it's just you have to be faster and quicker on your feet to do those ones.
Why do they do it like that? Why do they? I just
they love
think
to
that's
torture
we
us.
talked about this before. I'm like, it just seems so ineffective to me and so unfair. And it's also another
there
thing
needs to be a press conference next week. I need to announce something to my electorate. Right?
Oh, it's just like, haven't founders got enough going on, and then they're going to sit there and watch the grants that are coming in as well. It's like, my God.
Yeah. Georgia, I've got a question for Georgia, if that's all right.
Yeah.
Do you often come up against the objection when you're talking to businesses about grants that they don't know if they have the luxury of investing so much time and resources in like a project that goes for like maybe 12 months or 18 months or 24 months?
I think that's probably not the way I'd approach it, and that is I would never recommend that somebody creates a project to go for a grant. It's just never going to. The saying is sort of grant funding will make a project better, bigger, faster. It won't create a good project. It will make a good one better. So the company would already have an idea of they want to do this project, and maybe they would do it over 12 to 18 months. But with the grant funding, they could collapse that down to the 6 to 12 months. That's the sweet spot generally. Grant funding is there to help you do it better, faster, whatever the case is. It's not there to say, government, if you were to give me this money, then I could do this project over here, but without that, I can never do it. Because government wants to back winners. That's the whole philosophy of grant funding, right? It allows them to pick. R&D tax incentive, you qualify or you don't. There's no picking winners by government. You're the one, deciding whether you qualify as such. Grant funding, the government gets to pick. And so they're going to be incentivized to go, okay, these guys know what they're doing. So for instance, if you've got one grant already under your belt, you're actually more likely to get another one. because they all like to pile on and say, well, hey, somebody else believed in and they got grant funding and they did something with it. And wow, look, it's a success story. So we've got more assurance that if we put money in, we're going to get the same outcome.
Well, that's interesting. So if you get, that's really interesting. So you can just double down and be like the grant king or queen.
You will see some companies have picked up an awful lot of grant funding across a lot of categories. And then you'll see others who just struggle to get anything. And there's going to be some reasons for that are out of their control, depending on the sector they're in and just what they're trying to develop. But at the same time, you also see that, you know, once they've got a few, they're on a roll. And it's not necessarily because, you know, I'm sure they're very good at applying for them, or they're using people like us who are very good at applying for them. But at the same time, there is a certain amount of, you know, the rolling stone.
To use one of Benjamin's.
What I would say there, that is fantastic. So where we've seen companies, and there's some even in our portfolio that have gotten grants, that's a wonderful thing, because I do like the idea of OPM, other people's money. I know some of us have the luxury of OPT, other people's time, but other people's money is a wonderful thing. And that is great. However, when it comes down to a business that has got some product, can you keep selling to customers? Because I have seen many decks, met with a chunk of founders, and they say, oh, we won this award, won that award, won this grant, won that grant, which is wonderful. It's like, boom. But have you got customers? And if you're able to then leverage that into getting customers and having customers raving about you and those raving customers referring you to new customers, etc., that's double goal.
Yeah. And Georgia, you know, obviously a while back we had this whole Airtasker debacle, and we've got a few founders now that seem very gun shy of the whole R&D process. And what's your advice around that? Has the government changed their view on that? Is there more? I think the whole thing was that a lot of founders felt it wasn't very clear what the requirements were. And has that changed at all?
Look, I mean, Airtasker, one, we weren't involved. But two, probably more importantly, is the legislation actually hasn't changed in terms of what qualifies as R&D. That hasn't changed in 10 years. What has changed, I suppose, is some of the financial benefit, but also more importantly, government every few years releases revised guidance. The guidance is trying to help companies identify and better claim. But what you do see is that you can get inconsistencies, right? What one assessor says as opposed to another assessor can vary. And you also probably saw originally when the tax incentive in its current form came out in 2012, there was a bit of a gold rush by companies. Everyone was claiming everything. And then there was almost like a squeezing down of government going, hang on. And so there were these taxpayer alerts that were issued in 2017, where the government was like, my God, you're going crazy here, guys. Just settle down. Not everything is R&D. Do it properly, and we're seeing sort of that come through. There was the Small Business Ombudsman released a report in December 2019 saying, hey, look, government, get your act together. This isn't really necessarily being administered the best way for business. And so through COVID, we saw probably a bit of a correction there. So, if you put in an R&D claim, will you be reviewed? At some point, almost certainly, particularly if you're a first-time claimant, then that they will want to look at that. And that's probably why it's really important to go in, get good advice and understand that not everything you do is R&D. And in fact, it might be nothing you do is R&D. Just because you're a startup doesn't mean it's R&D.
Yeah.
So understanding that and going in and also making sure that you document things and that you're ready, I suppose, not just for a review by government, but also by your investors. If you're looking for a trade sale down the track, you want to make sure that, in the case of the acquisition that I mentioned before, you either don't end up with a lower valuation or you don't end up with a holdback or something else because, it's like, well, hang on, should you have claimed those things? And not everyone's confident about it.
And my tip, having spent a lot of time with founders in our portfolio, some of whom claim the R&D tax incentive, is that the substantiation, the work that's required in order to put in the claim, it's great to get that done in real time, as opposed to banking that up at the end of the year and then you've got 12 months worth of paperwork, obviously digital these days, but digital paperwork to fill out. That's a lot of spreadsheets, a lot of forms. Better to do that once a week or once a fortnight or maybe even once a month instead of letting that bank up, because it's very difficult to recall. I have difficulties recalling what I ate for dinner last night. How could you recall what you did on a particular Tuesday 6 months ago? Was that R&D, that meeting that we had with those consultants? I can't remember.
I'd actually add, and then this is probably, you know, Joel can speak to this as well, that real-time part is really important. Number one, it probably means that you'll get more R&D, because what you remember doing as opposed to looking back and going, oh, maybe I spent a week on this, as opposed to you actually spent 2 weeks on it. But really importantly, it means that when you're looking to leverage, you know, services or fund options such as from Joel, that you have that assurance, because us as advisors can go, we know that you're documenting this, so we can put our name on the line to say, yes, we agree with you that's R&D. And then that means Joel and his team can say, yes, we're confident with that, and we can provide funding against that.
Yeah, we can move really quickly. Like, we can do monthly drawdowns in looking back at like what the previous month's spend was, but that works really well when you have a really good relationship with your R&D advisor and constant communication, so that like the administration around that can be really efficient as well.
Well, we have covered a lot of ground here, people. I think that's covered nearly all my questions. So what I might do is just throw it to each of you just to sort of finish off. If you've got any comments or any advice for founders right now. As always, I'll start with you, Benjamin. Chong.
Look, there is still money out there. Thank you very much, Amanda. There's still money out there. We are seeing deals. We are still seeing companies getting funded, and it is about presenting a wonderful business opportunity for the providers of capital and being able to argue well as to why you're deserving of it.
Yeah, and I love that comment, because I think, you know, we're hearing a lot in the press that it's sort of doors are shut, capitals are not, you know, blah, blah, and it's actually not true. We had a call yesterday with 6 VCs, all in very, you know, more earlier stage funding, but all of them were very much of the same message. Doors are open, we're looking at companies, want to see opportunities, you know, all of that sort of thing. So I think it is important to put that out there as well, that it isn't all doom and gloom. So perhaps don't read the AFR every day. Joel, last comments from you.
Yeah, I think I'd echo that. Like, you're right, the doors aren't shut. Like, definitely not on a Fundsquire side of things either. But like, in terms of maybe on the equity side of things, like before all of this macro stuff was going on, we were like seeing transactions maybe take like 6 months. Like, people talk about how they want to close their funding round in 3 months, but like often it goes a little bit longer. So now if you think about the current situation, then obviously it's going to take longer than that. Even though the doors aren't shut, it might be just a bit of a slower process to get access to that money. So I'd say plan very far ahead and look at what the alternatives are, and to make sure that you can plan for a longer cycle of getting that equity in the door. Fantastic.
Georgia.
Look, I would echo the same. I mean, there is money around. Even if you just look at the number of funds being stood up, that's continuing to accelerate. I think there's over 100 now early stage VCs. So there is absolutely funding to be had, but it is about being the right match. And then the other one is maybe stay tuned in terms of what comes out of the October budget from a federal point of view. We'll have a lot more information in terms of what government programs look like. So again, maybe a self-serving one. We do a budget brief. So pop onto our website and take a look at that, because that's what we'll be focusing on. And yeah, just remember, look around. Not all funds are for everyone. Not all grants. Pick the ones that fit.
Yeah, and when's is that the 26th? The budget? When is
25th.
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 Okay.
That's my lovely 2 a.m. fun time.
Yeah, I was about to say late night for you, Georgia. Anyway, all right, guys. Thank you very much for today. Really appreciate making the time. Enjoy the rest of your Wednesday. Thank you.
Thank you very much.
Thanks.